Hey guys, good afternoon, and I hope you're all doing great. So, in this video, we are going to discuss synthetic futures, a concept not very well known to majority of the option traders. Yes, there are still a handful professional option traders who understand this concept of synthetic futures, but this video is primarily targeted for those who are just beginning their journey in options trading. And in this video, I'm going to explain you how to discipline yourself to size your positions correctly, appropriately, understanding your capital requirements. That's where this particular concept called synthetic futures shines at. So in this video, I'm going to start with an introduction to synthetic futures. Very simple one. A detailed video will be shared later on, and then we will go to the execution, why precision matters, and how it is going to help you preserve your capital for a longer time period when you are trading options, especially, right? So let's start with one simple question. What is synthetic future, right? Synthetic futures has two words in it, obviously synthetic and futures. Synthetic is something that we create. It's not natural. Generally, when we talk about futures and options, we have future contracts and options contracts, which were designed and created by the exchanges. In our case, in Indian context, the exchanges are BSE and NSE primarily. So these exchanges create futures and options contract and we trade them, right? But synthetic futures contract is something that we can create on our own. That's why it is called synthetic futures, right? So that's the definition of synthetic futures. Now, what are the components of this thing called synthetic futures, right? So when we look at the futures contract of Nifty, you can easily search Nifty futures in your broker terminal, and one of those Nifty future contracts with a nearest expiry or maybe 3 months later, you will see a list of several Nifty future contracts listed there with different expiries on them, right? So here in this particular scenario, we are not going to trade that Nifty futures because that's a natural future contract that was created by the exchange. Here we are going to form our own futures contract using Nifty options. That is why we call it synthetic futures. Remember? Okay. Now, how do we do that? So, as usual, in any futures contract, there are two views that we have. There is no neutral view here. Remember this. There is no neutral view. We are not going to sell a straddle or a triangle thinking that market will be range bound between this and this price. So we are going to strangle or straddle these options. That's not the case here. That's a neutral scenario, right? So here, one of the major decision that you have to make when creating synthetic futures is your bias. Are you bullish or bearish, right? And with that said, there are two different contracts, synthetic future contracts. Obviously, one is bullish and one is bearish. So you can create a bullish combo and you can also create a bearish combo using options in synthetic futures, right? So what is a bullish combo to start with? A bullish combo, as the name suggests, our view is bullish. Our view or analysis says that Nifty will be bullish. So how do we create a bullish combo in options and subsequently translate that into a synthetic futures? That is what I'm going to show you in a few seconds from now once the current candle finishes its formation in 5, 4, 3, 2, 1, go. So what happens when we are bullish? When our view is bullish, what we say is the prices or the premium of put option will decay and the premium of call option will increase, right? So that is the definition. So now let's say if we are bullish on Nifty, there are two things that we can do, or in fact, three things that we can do, right? One is we either sell put option. The second one is we buy call option. The third one is we buy the Nifty futures contract, which is created by the exchange. And this is the fourth option that we can create on our own, where we sell a put option and we also buy a call option, right? What are we doing here right now? The black line that I just drew on the chart is essentially our limit order. Limit order for what? Limit order to sell a put option and to buy a call option. So here, what is my analysis? My analysis is most likely Nifty will close about 24,000, and that's the reason what I have done is I have sold 24,000 put option, and also I am buying 24,000 call option of next week's expiry. So the previous expiry was just yesterday. So the next expiry of this particular options contract will be on the Tuesday next week, right? That will be 28th of July. So here, this particular contract, I have placed my limit order to sell a put order at 170 rupees and buy a call option at 148 rupees. So how do I manage my risk here? My stop loss will be just above the swing high. So this is our current swing high, and that is our assumption as of right now. And this is our swing low on the call option. So here on the call option, my stop loss will be, I will have a small buffer on my stop loss because in buying option, there is something called theta decay, which you might already be aware of. Right? Now let's wait and watch. Now if I take you to the 1 minute chart, right? So on a 1 minute chart, this trade has already been executed. And also on a 5 minute chart, as you can see, the trade has been executed. I'll just add a text here, 24,000 PE sell, and this is our 24,000 CE buy, right? So this is our synthetic future now, perfectly executed. We have sold the put option and we have bought the call option, and this is exactly what a synthetic futures is in reality. Okay. Now let's get to a point where we discuss how it is beneficial for a retail trader like me, you, and everyone else, how it is going to help us. So if you remember, one of the things that I have mentioned is it is going to help us preserve our capital. Okay. So let me get to that point and dig a bit deeper in that particular scenario where we discuss how it is going to help you preserve your capital. Let's say, let me get the text box here. Let's say we have a capital of 10 lakh rupees. Okay. So this is our capital. If we only buy options, in option buying, we can probably buy, depending on the price, depending on the premium, we can probably buy, let's say, 50 lot, right? And if we are selling options, we won't be able to sell more than 5 lots here, right? Now, we are doing both. We are buying and selling as well, right? So what is the capital that we are going to use here? Let's say for an example, this particular put option that I have sold, 170 rupees, the usual capital requirement to sell a premium that is at 170 to 200 rupees will be around 1.8 lakh to 2 lakh. If it is on expiry, it will be close to 2 lakh or slightly above 2 lakh. If it is a not expiry date, non-expiry date, then obviously it will be below 2 lakh rupees or around 2 lakh rupees. Let's go with the ballpark that it is going to take a 2 lakh rupees to sell one lot of the put option that we just sold here. Now, how much capital it's going to take to buy a call option that we have bought, right? So premium calculation for selling options is obviously done by the exchanges and the uh, brokers. So here in option buying, you can easily calculate this, right? So we have bought it at 148.10, 148.10 into 65, right? To buy this particular option, it's going to take only about 9,700 rupees in my account, right? So now imagine with 10 lakh rupees capital in your account, how many of these contracts you can buy, right? That's exactly the math here. This is exactly how it is going to help you preserve your capital for a long run if you're using a decent capital. Well, I have seen people who are buying options, naked options, even with a capital of 20,000, 25,000, they make profits here and there. 1, 2 days they make profits and they take their capital to 50,000, 60,000 and lose that entire profit along with their capital within a week. Has that happened with you? Comment below if that ever happened with you, right? So that's not the right way to buy options. We can definitely buy options as a hedge or at least as a synthetic future, right? So here the trade is going in our direction. As you can see, we have already captured around 14 points in the put sell and around 8 points in our call buy. So the cumulative that we have captured as of right now, the example I'm giving you is the real current market price, right? So net we have captured around 25 points in this particular trade. With 10 lakh capital, we could have sold 5 lots and also bought 5 lots. Okay, so that makes it 10 lots in total. Okay, on 10 lots is basically 650 contracts. We have made 25 points. Okay, and that will be plus to the amount 650 into 25, 16,250. That is our current unrealized profit. Okay, so this is the power of it, right? So this basically says what? This is basically saying in one trade that we have just now executed, we managed to make around 1.6% of our deployed capital in one trade. Right? Now let's say the other scenario where you can argue that what if the losses happen, right? So let's say if we lose 25 points, loss of 25 points. That is what I have considered in profit. So that is exactly what I'm going to consider in my loss calculation as well. So even in that case, how much will we lose? We will lose only 1.6%. Okay. Now that is the beauty of this thing, right? So synthetic futures forces you to buy or sell only those many contracts. Or in fact, even better definition is synthetic futures will force you to buy only those many contracts you are capable of selling. Alright? That is the definition of it. This is exactly how you are going to preserve your capital using synthetic futures. I'm not going to create an unnecessarily massive position just because I have 10 lakh rupees in my Demat account or in my broker account. I'm not going to buy 50 lots, right? So what would have happened if I had only bought options, right? If I had only bought naked option here, let's say in 10 lakh capital, I could have easily bought maybe 50 lots, right? 50 lots. Decent. 50 lots is a okay size here, right? So let's say how many 50 lots? 50 into 65 is 3,200, 148. Okay. We could have bought 100 lots to be very frank. But even if I'm going with 50 lots here, what would be the loss if I lose, let's say, even only 10 points? Let's do the math. How much would I lose? Only 10 points I'm talking about, right? So 50 into 65 is 32. 50 into 10 points. That will be 32,500 rupees loss if I had bought naked options. Only losing 10 points, right? And how much capital would you require to do that? 65 into 50 into 148. That is around 5 lakh. Of 5 lakh, we are losing 32,000. Imagine that. That is around 7%, close to 6.5% of your capital vanishing in one trade if bought naked options. Sell it. Yes, obviously you cannot sell more than 4 or 5 lots. How much would you lose in selling? 65 into 5 into, even if I consider 25 points in loss, that will be only 8,200 rupees loss approximately, including taxes and brokerages, everything. And that is of 10 lakh rupees capital. That is 0.8% in loss. Now compare that. Where is 6% loss and where is 0.8% loss? But you are still managing to capture 1.5, 2% of your capital in one single trade, right? So guys, my whole agenda of this particular series is to make you aware of this concept called synthetic futures, because I have seen so many people with such a massive capital losing not just 10 lakhs, 20 lakhs, 50 lakhs. I have even seen people losing crore plus buying options with zero idea of how options work, right? So this entire thing that I have just explained you about synthetic futures is going to help you preserve your capital. What am I saying indirectly? Or even for that matter, what SEBI is saying indirectly? I'm saying you should only buy those many contracts that you are capable of selling. If you have a capital to sell only 2 lots of Nifty options, you should not buy more than 2 lots of Nifty options. That gives you a breathing space to hedge your position, protect yourself from massive drawdowns and all of that, right? So for now, in this video, this is all I had. This is a series, right? And this is the very first video that I wanted to share on this particular channel. Support the channel, and I'm going to publish more and more content related to synthetic futures. How easily you can make decent profits using synthetic futures, or even for that matter, naked option selling as well. That is the whole idea behind this entire channel, to help retail traders, especially those who are incurring losses regularly buying options and losing a lot of money. I want to kind of put a full stop to that. It hurts me to see people losing their hard earned property. I've seen people selling their flats, seen people losing their well paying jobs, well paying as in like really, really well paying, right? 3 lakh, 4 lakh plus salary in their account. Yet they made a decision to start a career in option buying without even knowing the ABCDs of it, and they lost all of it. They lost their job, they lost their property, they had their apartments bought in cities like Bangalore, Noida, Gurgaon. They lost that too, right? So the whole idea behind this channel is to spread awareness about how to buy options properly, position sizing, how to be consistently profitable with a limited capital, right? So that's the whole idea. If you like this video, if you like this kind of content, make sure you hit that subscribe and share it with your friends. There's a lot to come on this channel, and I really need your support, guys, to spread this awareness to as many people as we can. And thank you so much for joining me in this video. I'll see you in the next one.